The impact of inflation on your investments. Inflation is a form of economic pressure that can slowly deplete one's savings. It is the rise in the cost of living that occurs when there is insufficient money in circulation. Inflation will chip away at your hard-earned income and savings as prices rise. It is critical to understand how inflation will affect your assets and how you can avoid it to remain on top of your economics. To preserve their money and account for these changes, investors must be aware that inflation will reduce the value of their assets. Assume a scooter costs $100 today, and the current inflation rate is 2%. The scooter will cost $102 next year, assuming price increases in line with inflation. But before we continue, let's not forget to support our channel by leaving a like right now and smashing the subscribe button. Enjoy! What effect will it have on investments? Inflation's impact on investments varies depending on the type of investment. Because you get the same interest payment each year, inflation can impact the performance of assets with a fixed yearly return, such as ordinary bonds or bank certificates of deposit. For example, if you receive a $200 payout each year, it will be worthless after a year owing to inflation. Inflation can have a mixed influence on stocks. When the economy is doing well, inflation tends to be high. Companies may be selling more, which might boost their stock price. However, corporations will have to pay more for personnel and raw materials, lowering their value. The performance of the firm behind the stock can determine whether inflation helps or hurts the stocks. On the other side, precious metals such as gold have historically performed well when inflation is high. When the dollar value falls, it takes more money to buy the same amount of gold. Finally, some assets are inflation indexed. They earn more when inflation rises and less when inflation falls, resulting in more consistent overall earnings. Some bonds and annuities charge a fee for this function. How to prepare for inflation? Inflation may diminish the value of deposits over time, which is one of the main reasons why many people do not place all of their money in the bank. As a result, some people prefer to keep some of their money in potentially higher growth investments, such as equities or mutual funds, which yield more per year than the inflation rate on average, even though they also face the risk of lower gains or loss. When deciding what kind of investments to include in your portfolio, you should also consider inflation risk. Inflation can harm fixed investments, such as bonds and fixed annuities. Some investors prefer to diversify their portfolios by including gold or inflation-indexed investments. Inflation is an unavoidable market force that cannot be avoided. However, by anticipating inflation and implementing a sound investing strategy, you may be able to reduce the impact of inflation on your savings and long-term financial goals. If you like this video and would like to hear more, be sure to press the subscribe button.